It always happens, right? You always seem to miss the stock market bottom. And then, even worse, you miss the rally that ensues. You might then be compelled to FOMO at the highs before the market drops again. Then you miss the bottom before the market rallies once again. It is a vicious cycle that has to do with human psychology. But in this video, I aim to make you a better investor in just one video. Yes, you got that right. Just one video. I aim to make you a better investor. So stick with me, because what you learn here, you will likely be able to use for the rest of your life. Now, even though this video is evergreen and it's not time constrained, as of the time of this recording, we caught the bottom on the SPY. We also caught the recent bottom on bonds, and we also caught the bottom on small caps. By the way, I did a whole write-up on my Twitter. Make sure you are following me on X for free daily trading and finance content. But I did a whole write-up on X with timestamps and proof on how we caught the bottom on these things, and I'm going to teach you how in this video and how to apply this to whatever stocks you're looking at. This video is going to be split into 3 parts on how to find bottoms in the stock market. The first part will be fundamental, the second part will be technical, and even if your technical analysis is not proficient, I guarantee you will learn it here. And the third part is going to be psychological, because funny enough, this has more to do with why you keep missing stock market rallies than anything. So without further ado, let's get right into it. How to find stock market bottoms. Now, before all of this, I just want to say it is hyper important not to be fixated on the stock market bottom. Now, you're probably thinking, why would you say that? This whole video is about stock market bottoms. Well, no, this whole video is really about changing your psychology so that you don't miss the next rally. Here's why I say don't focus so much on stock market bottoms, meaning don't make it your aim to just target the bottom each and every time. Here's how rich you would be if you just focused on stock market corrections, meaning a drop of 10% to 20%. If you bought every single correction going back to 1980, look at the returns after 1 year. Look how violent the returns are after a correction. Minus 17%, the following year was a 33% gain. Minus 19%, we had a 9% gain. Minus 15%, 43% gain. Minus 14%, 57% gain. Minus 14%, 30% gain, so on and so forth. The gains coming out of a correction are so violent. We're going to get into more detail about why it is so important to buy corrections later. But if you take anything away from this video, it is to buy the corrections on blue chips and stocks that you want to own. I am not talking about meme stocks here, okay? All right, so the first part, fundamentals. You want to pay attention to things such as inflation, interest rates, Fed rate cuts, stimulus. Also, is there an event that is likely to bring more liquidity into the market? Back during the pandemic, when they printed $4 trillion and dropped interest rates to zero, those of us who were very familiar with the fundamentals of the stock market and how liquidity is the #1 driver of stock market prices knew that we would see a violent rally. Let's take my gold trade, for instance. We had a trade on gold where we made $11,000 per contract. How did I find the bottom on gold? Well, this had little to do with gold and really more to do with the dollar. See, because I understand the relationships between interest rates and the dollar and between the dollar and the gold, I was able to put on this trade. As you can see here, I said if CPI comes in line or lower, then rates will likely drop along with the dollar, propelling gold for another run. Now, gold also happened to be in a technical pattern here that I recognize as being bullish, but let's leave that aside for now. I thought there'd be a high chance that inflation would be beat because I've been tracking inflation for 3 years and have been monitoring the trends. Now, obviously, I could have been wrong, but I actually waited until CPI dropped before taking that gold trade. And so when inflation came in lower than expected, when the Fed decided to skip, I knew that yields would drop, because if bond traders are not expecting the Fed to raise rates, they're going to try to take advantage of current yields. Now, when interest rates drop, keep this one in mind, when interest rates drop, the dollar also drops. But there's also an inverse relationship between the dollar and gold, almost a direct inverse relationship. When we get to the technical portion of this video, I'll show you some tools that I use in order to find these relationships. So then when I looked at gold at the same time, gold was in a pullback, right? In a pattern where we expected there to be a continuation if the conditions were there. Now, as you get better with fundamentals, and really the only real way to get better is to keep reading, keep yourself abreast of what's going on in the financial and economic conditions, and understand these relationships. The more you are familiarized with this stuff, the more you will understand these relationships. But in short, dollar and interest rates move together. If interest rates go up, the dollar goes up. Now, there are some commodities that are inverse the dollar, gold being the main one. Sometimes Bitcoin is there. Again, I will show you a tool when we get to the technical portion to see how these relationships play out. And sometimes oil is inversely related to the dollar. So when the dollar goes down, oil goes up and vice versa. But between the gold and the dollar is almost directly inversely related. Now, there's also a relationship between interest rates and stocks, right? We all know this. When interest rates go up, especially the long-term 10-year plus interest rate, then that is a tough environment for stocks to rally in. However, when 10-year plus interest rates start going down, then we tend to see a rally in stocks, or at least provide the conditions for a hopeful rally in stocks. Now, let me show you my example on small caps and how I use fundamentals here. I pulled up this chart and I saw that small caps had the worst performance against large caps going back to the 1930s. Now, if you guys know anything about this channel, you know that I love extreme situations. Extreme situations provide the juiciest opportunities. When you see headlines like, this is the worst bond market ever, this is the worst small cap market ever, that shouldn't cause fear in your mind. Your mind should already be tuned to, oh my God, there might be an opportunity in bonds. There might be an opportunity in small caps. Because these things don't happen very often, the opportunities might be the juiciest ever because this is the worst ever performance. Think about it when it comes to upside. If something is already beaten up more than it ever has, the news will have you think that the downside is more viable. However, the upside is more viable because it is so beaten up, more so than any time in history. How much more could it get beaten up? So you have way more upside than downside. You have to shift your thinking. And we'll talk about this when we talk about psychology. And same thing with bonds. Back on November 8th, again, this is not a time-sensitive video, but just to show you what I said. Bonds have seen the worst crash ever, which is not surprising as the Fed has hiked the most aggressively ever. When the Fed hikes very aggressively, that's when yields tend to go up. And I know the relationship between yields and prices. When yields go up, bond prices go down and vice versa. But I also knew that the Fed was getting close to being done with hiking. So as this worst bond crash in terms of bond prices was occurring and the Fed was likely done hiking, well, then probably that extreme is coming near an end. Now, I use my technical skills in order to pinpoint levels at which I want to buy. But even if you threw technicals out the window and you just knew fundamentals, you would be in a good spot for the long term. All right, let's talk about technicals here. Now, this is the fun part for me. I don't know if it will be for you, but I guarantee you, even if you're not good at technical analysis, you will learn something here that you can apply to your long-term holdings. You could see here October 25th when I said that I was going to be buying the SPY at 410, which was the bottom of the current correction as of the time of this recording. How did I find that 410 level? Was it magic? Well, there are a number of things that I used here, but technically one of the things that I use is called the volume profile tool. So this volume profile, if I click here at the bottom right around the time where I was looking to buy, and I go all the way back to all-time highs on the SPY, right? I want you to see something here. The most volume that we ever saw on the SPY was at 410. And this is something that you can see here that I used in my thesis almost 2 months ago now. I want to know historically where there are heavy buyers. Now, this most likely is not retail buyers. Retail buyers cannot generate this much volume. So it also gives me a glimpse into what level institutions tend to buy at, because this type of volume, only if institutions are involved can this type of volume be registered. So that's technical tool number one. Technical tool number two. If you guys are familiar with this channel, you know that I always buy blue chips at 50% retracements of the previous rally. So you see this rally here on this chart from March 23 all the way until August 2023. If I pull a fib here, look at where the 0.5 fib is. I always try to buy in discounts at the 0.5 fib, which is basically all that means is 50% down from the recent rally on any blue chips I want to buy. This applies for me, applies only to blue chips. So if there's a speculative stock like DocuSign or SoFi or PayPal, this doesn't apply. But for blue chips that have a long standing in the market, your Apples, Microsofts, SPY, QQQ, even things such as Walmart, Coca-Cola, whatever value stocks that you like, this applies as well. Stocks that are blue chips that have a marquee name, that have a long standing not only in the marketplace, but also in the stock market. I always buy if I'm looking to add to my long-term portfolio, and I can get these things at a 50% discount of the previous rally. That is a heavy buy point for me. Now, remember, going back to what I said initially, I don't care if this is the bottom because I know that I'm getting a discount for the long term. It just so happens that along with fundamentals and some other technicals, I can more likely predict a bottom. Even if I'm not right, I can come close. And even if I don't come close, I don't care, because for the long term, 50% discount on a blue chip, come on, guys. So even if you employ only these two things in terms of your technicals, just a 50% retracement of the previous rally and show me where a lot of volume is focused on, you will already be that much better of an investor. Maybe not a trader or a day trader, but we're talking about investing here. Now, obviously you can enhance this the better you get at technicals. So another thing that I was looking at, for instance, was on this head and shoulders that you see here. I'm just going to draw it sloppy, but this right here is a head and shoulders. Now, from head and shoulders rules, the measure between the top of the head and the neckline, you expect that the drop after the head and shoulders is confirmed to equal that from the neckline below. And so if you look at this, the head to the neckline was about 4.5%, and then the break below the neckline was another 4.5%. Now, by the way, if you don't believe this, go back and watch this video from September 25th, which is 3 months before this video is recorded, where I explain what I'm looking at on the SPY, and I go over all of this stuff before it actually happened. Click right here if you don't believe me. And by the way, when I took that gold trade, I used a very similar thing. Even if you don't know the relationship between gold and the dollar, I used a very similar thing. Here you can see the volume profile. This is where most of the volume for gold was centered going back a year. All right, so in TradingView, I'm going to show you how to find correlations between assets. So here's the dollar. If I want to know how correlated the dollar and Bitcoin are, I can go to indicators and I can go to something called correlation coefficient. So if I go to correlation coefficient, here I type in BTC, USD, hit apply. You can see down here the correlation between the dollar and Bitcoin. And you can see that the correlation is actually all over the place. There are times when Bitcoin and the dollar are actually correlated. There are times when Bitcoin and the dollar are inversely correlated. So there isn't a great relationship that you can derive between Bitcoin and the dollar. Now, if I do gold, look at how most of the time gold is inversely correlated to the dollar, right? Almost to the -1 mark, that gold and the dollar are inversely correlated. That means when the dollar goes up, gold goes down, and vice versa. These are the types of relationships that you want to know. And I just want to pause real quick here and let you know that on January 7th, 2024, we are doing a free mastermind. Our mastermind series is 8 classes, 4 weeks. We have a module on technical analysis, a module on trading, a module on option selling, and a module on futures trading. So we are making the first class of this mastermind absolutely free to everybody. Click the link below and join. And if you want to join our monthly membership to get advanced notice to all of the trades we're looking at, all of the long-term holds, my fundamental analysis, my technical analysis, etc., my futures trades, my options trades, my option selling trades, sign up below and make sure if there's a coupon code there, you use it, and I'll see you in the academy. All right, and the last bit that I want to talk about is psychology. So on this thread where I was going over how I found the bottoms in the SPY, in IWM, and in bonds, the last thing I said was the problem with perma bears is they never have a buy target that's good enough. Turn that off. It's not conducive to investing at all. I said, in my opinion, perma bear channels are the most harmful obstacles to investing, creating wealth. They make a shit ton of money off clicks. They generally have higher views than unbiased finance content. But here's the important part. You are scared away from investing because they always tell you it's going to get worse. Then when you miss the rally, like you always do, they become a source of comfort, which is dangerous. They help you take out your anger on the Fed, manipulation, the government. Here's my point, guys. If you are consuming investing content, you have to at some point be open to pulling the trigger. Otherwise, there's absolutely no reason to consume investing content. So if you look at this chart I showed you before that I said will come up later, buying in a correction is literally the best time to buy. The gains following are usually extremely violent. And what is the alternative, guys? FOMOing at the highs, like most of you who didn't buy the dip are asking whether you should do it now, or how most retail who invest in the stock market get dumped on at these highs. Would you rather be now making a decision whether to hold or to sell, or making a decision on whether to buy the highs? You want to fade the market. Just like if I told you that Lamborghinis were 50% off, you would scrounge and look for every quarter in the couch in order to come up with the money to buy that Lamborghini at 50%. When it comes to generating wealth over the long term, people don't have that same mindset, but they should. There is no wealth generator like the stock market. And before you consume headlines like this, because you will always see them with every correction, is this time different? Is it something more serious? Before you consume that, just think about something for a second. The stock market has been around since 1900 and and slightly before. The stock market the way we know it. Think about what's happened since then. First World War, Great Depression, Second World War, dot-com bust, the Great Financial Crisis, which was the worst financial crisis in history going back to at least the Great Depression. Think of all of the things that have happened, all of the people that have died, all of the money that has been lost, and the stock market yet still keeps on ticking. Here is the monthly chart of the S&P 500. Look at this. This is absolutely insane. The SPY went from $40 to $470. It was unfathomable to have a $1 trillion company just 20 years ago. Now we have 4 or 5 of them. Now on October 26th, which was the day before this rally, as of the time of this recording, I said the one thing I can guarantee you about the stock market crash is that most retail will not buy. When the market rips, it'll be fast, violent, and surprising, just like it always is. And if you look at the comments on this tweet, people were calling it prophetic or, Nostradamus-like or whatever, but it's really not that impressive because I have the data in front of me. I know how the stock market works coming out of correction. Just remember, you have 2 alternatives. You either buy the correction or you buy at the highs. Which one would you rather have? And remember that the stock market is up 3 out of every 4 days on average, going back to World War II. The stock market is built to go up. It is forward looking. This is something that newbie investors and perma bears don't get. The stock market is built to go up. This is why we have forward projections, forward EPS projections, right? We have forward guidance because it is meant to price in what a company is going to do. It is meant to price in growth. It is meant to price in inflation. It is meant to price in increased spending. The stock market needs a much bigger reason to drop than to rally. So use these tools that I've given you here, the fundamental, the technical, the psychological, and use that to build the foundation for you to then come up with your own investing plan. Anyway, traders, that is it for this video. If you got anything out of this video, give it a big fat thumbs up. Leave it in the comment section below. Let me know what most you got out of this video. Is there something that jumped out at you that you didn't know before or that opened your eyes to something? If you have any feedback or things that you think I should have included, maybe, do a follow-up video on, let me know in the comment section as well. Subscribe to the channel, hit that notification bell. Stay safe out there, traders. Peace.